Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. Well, listen, Mike and Ryan, listen, guys, I want to say thank you for taking the time today to go through really what's been kind of an interesting quarter. I mean, it seems like 2016 was just riddled with events that were taking place that surprised everybody. And sure enough, we had another one in the fourth quarter. So, I'm really anxious to hear about what your comments are and to get a bit of an update on things. So I'll pass it over to you and we'll take it from there.
That's good. Thanks, Scott. It has been an interesting quarter, and we're going to share a lot of updates from a performance standpoint, market standpoint, how we see the world unfolding moving forward. And I'm just going to draw your attention quickly to the disclaimer at the bottom that really a lot of the things that Ryan are going to be sharing are more for informational purposes only, and the views expressed are the views of the speaker and don't necessarily represent the views of the firm. But a lot of what we're talking about does as well. So as I said, we're going to talk about some performance highlights. We're going to look at the current investment market themes and outlook, economic factors driving the markets these days, and our current portfolio positioning. So first of all, let's take a look at back in time. Quick highlights from last year because you've seen this before, but 2015 was a pretty good year for global equities, as you can see. Markets up around 20% on average. A lot of that was currency gains. Canada took it on the chin a little bit, down 8.3%. And bonds had an okay year at 3.5%. Our performance was quite strong right across the board, as you can see. All the mandates outperforming the Canadian marketplace, kind of in line or ahead in a lot of cases on the global U.S. international side. Alternative investments added a lot of value. Multi-strategy up 17%, real estate up over 9%, infrastructure up over 21%. So overall quite a good year. As you said, in quarter four, there was a number of surprises. The big one being the U.S. election, which we talked about on the last call as well. But it's now President Trump, and a lot of things seem to be changing every day, and we'll talk a little bit about that further in the presentation. Following that, what was also kind of an equivalent surprise is how strong the markets rebounded. Sometimes, when there's less uncertainty in the market, or actually oftentimes when there's less uncertainty, the markets like that and move forward. And even though Trump was not the expected outcome, the fact is he's planning on injecting a lot of capital, reducing taxes. There's a lot of things that he wants to do that could well drive the market forward. So very quickly the market reacted, and you can see just the 3-month outcome to returns in the U.S. Here's the annual returns just for your interest. But in quarter four alone, the U.S. was up almost 6%. Canadian stocks up 4.5%, international equities up 1.3%, and bonds down 3.4%. So that was a big turn. Bond yields rise quite sharply, and that cost bond investors a little bit of short-term return. And that's something that we've been talking about now for quite some time, about our fears that interest rates might start to rise, and that could mean lower single-digit returns or even short-term negative returns in the bond market. So we need to think ahead for these kind of things and build portfolios that will be resilient in that kind of environment. Quarter four, across the board, you can see how the markets did in the purple, how we did in the gold. So all of our bond portfolios actually outperformed the bond market. You'll notice that the fact that we had some short-term bonds and high-yield bonds in the portfolio helped to protect on the downside because there's less interest rate risk there. Versus core bonds, we did a little bit better, but that was certainly a weaker part of the pie for us in quarter four. Canadian stocks did quite well, up 4.5%, and our mandates did quite well as well. One of them falling just a little short, small cap not doing as well as large cap. But you can see our Canadian value portfolio in 3 months alone of 9.4%, and for the year, one of the better performing asset classes right across the board, up 27.7%. Global equities in general, pretty good here in quarter four. You can see how we did relative to the U.S. outperforming the market. International, on the other hand, was a bit of a weak point, and I'll talk to that as to what's been driving a little bit of weakness for us in that area. Multi-strategy has also been a little bit weak, so I'm going to address that in a few slides following some of these upcoming pages. Real estate, pretty good quarter. Quarter three up 2.8, infrastructure up 6.4, and for the first 9 months of the year, pretty solid return. The one-year numbers are also looking very solid in those asset classes. Now, for the whole year 2016, there was political surprises we talked about. Not just talking about the Trump election, but the Brexit vote in the middle of the year. That was also a bit of a surprise. Canadian stocks really bounced back quite strong, and that's why I want to show you 2015. Sometimes, sometimes when things go down one year, they could go up a lot the next year, and that's why we don't want to just throw all our eggs in one basket. Looking back in time, TSX was down 8.3 in 2015. 2016 it was up 21.1, so quite a dominant year for Canada. A great recovery off the lows when oil went down to $28 a barrel. Now it's up around 53. The exchange rate went from 68 cents back up to the 76 cent range now, and it did get up pretty close to around 80 cents a little while back there. And bond yields rose as I showed you in quarter four, and that created a bit of a downward impact on the overall year. Bonds were actually up over 5% after the first 9 months of the year, now ending up with a fairly modest return at only up 1.7.
Now I have a question for you. So the Canadian equity, very very market last year, but the year before that it was not a very strong market. And are we seeing this as potentially just a pendulum swing that's maybe swung back the other way? That maybe, and I guess the next question is that sustainable?
Yeah, so no, we don't think this is sustainable, and we don't think past stock market returns in general are sustainable moving forward. So that's something we'll talk about later in the presentation around forward expectations for stocks and bonds. But I think, this pendulum that you talk about, that's kind of the new normal in the markets. Emotion is a big factor with the markets, and, I've often used this analogy of the markets working like a light switch. Last year for Canada was risk on. Everything that went down the previous year went up the most, and everything started working again. But when it switches to risk off, it can overshoot to the negative as well. So I'd say 2015, probably the TSX didn't deserve to go down quite that much, but emotion kicked in and drove it down 10%. So a lot of this recovery was just undoing some of the overshoot from 2015, and then the positive momentum has continued to carry it forward. Same thing in the global markets, where it was up over 20%. We saw a bit of a correction there. The U.S. had a much stronger recovery towards the end of the year, which led to a plus 8.1% rate of return in Canadian terms. But you'll see international investments still quite weak. We don't think it's going to continue to tilt back and forth like that. You can't count on that. But oftentimes when something does overshoot and it seems like it's a little bit extreme, sometimes you can count on a bit of a recovery following that at some point in time when the market starts to make more sense. Stock market returns around the world, you can see this is just in local currency terms. So when I show plus 10 in the U.S., that's in U.S. dollar terms. This is in Canadian dollar terms, etc. So generally a strong year. China had a bit of a weaker year because of some of the slowing growth that they're seeing. UK, ironically, had a pretty strong year in local currency terms, mind you, despite the Brexit vote going counter to people's expectations. So what worked and what didn't work in 2016? I've already talked about a couple of things that didn't work. Global large caps, namely international stocks for us, didn't work so well last year. Multi-strategy, which has had a very solid 3 to 5 year track record in the past, adding a lot of value relative to what we've seen in the core bond markets. It's had a bit of a weaker year, and I'll explain that in the coming slides. What worked, on the other hand, all bonds, in particular high-yield bonds, had a great year. Canadian value stocks had a really strong recovery. Canadian small caps as well. That was a bit of a weaker point in 2015, both those portfolios, but they had a strong recovery last year. Global small companies did very well for us. Real estate, infrastructure, also quite strong. And here's the numbers in a nutshell. Bond market up 1.7. All of our portfolios did better. Our core bond portfolio about 0.6% better. High yield bonds, very solid year, up 8%. Canadian stocks all looking pretty good, in line with the market, or in some cases quite a bit ahead. Global Alpha, which is our small cap portfolio, up 9% relative to the market at 3.9. So that's some good value added there. But in the U.S., we fell a little short of where the market was at 8.1. But more namely on the international side, where the market was down 2, and we were down a fair bit more than that. So I want to just touch on that, just to give people some perspective as to why that happened. Same thing here with multi-strategy, down a little bit for the year. Following last year, where it was up 17, the year before up 9, the year before up 25. I think people certainly were hoping for a better return than minus 0.6, but not completely unexpected given how strong things have been in the past. And the real estate infrastructure both had a very solid year. So don't need to spend too much time on this, but our global equity style is really to focus on return on invested capital. That's what ROIC stands for. So really we're looking at quality growth companies. And you can see over the long term, from 95 to present day, how the S&P 500 has generally done and how the high return on invested capital companies have done relative to that. So there's been quite a high level of outperformance. Last year was just not a year where a return on invested capital was a style that was favored. Another way of looking at this is that we might look more on a quality growth mandate, but really what drove that, and we're really overexposed relative to the benchmark in growth stocks, more earnings variability focused stocks. But then there's another part of the market focused more on value and dividend yield. And you can see that in 2016, these are the areas that performed the best, and we were underexposed to those. But this style, which does tend to work long-term, as I showed you in the previous slide, didn't deliver the same kind of solid returns. So our point is that our current positioning has not been rewarded, but sometimes you got to play the long game and wait for the style to come back in favor, and we do expect that will turn. Multi-strategy was another portfolio that had a bit of a weaker year. We don't get into a lot of detail on these calls as to what the fund is, but essentially there's 3 different market neutral styles. There's a quantitative equity approach, a small cap equity approach, and then a bond or fixed income approach. Because different styles will work at different times. We want to be diversified in the space. Well, you can see last year, the 2 of the styles did okay, up 6%, up 4%. It was really in the small cap space where the markets didn't really lend itself well to our style, where we pick quality companies to outperform poor quality companies. And what happened in 2015, it was a poor year in the smaller cap space, in particular in the mining sectors and energy. And quality companies outperformed poor quality companies quite dramatically in 2015. But when the light switch flicked to risk on in 2016, whatever went down the most in 2015 went up the most in 2016. So this mandate has been a very solid performing mandate for years. Last year was quite a weak year where, believe it or not, poor quality companies outperformed higher quality companies, and on average within the portfolio by about 10%. So not a great year last year relative to bonds, so a little bit of value impact there. But we do think that this style will turn back around. Long term, you can see how the numbers for this portfolio have worked relative to bonds, over 8% compared to 5.4. Standard deviation is still very low, and that's how we measure risk. So we look at this as more like bond type risk when you compare it to stocks, quite a bit lower with quite a solid return. And moving forward, we think bonds will continue to feel some pain in this low and rising interest rate environment. So we think it's one of the tools that will benefit clients, not just in the past, but moving forward.
Yeah, and I think as well in this, people have to recognize that, the historical performance of the fixed income market was during a declining interest rate environment. And so when you've got the multi-strategy here that seems to have outperformed over that same time period, it was much easier for bonds over the past many years. Moving forward, it's going to be much more difficult for bonds. So, I think people have to keep that in perspective that, we have just come off of a 30-year bull market with the fixed income side, and we've kind of hit that inflection point. We've hit that turn, and going forward, it's going to be that much more difficult. So when we look at these numbers, and what I'm seeing here is that you've got the multi-strategy has done exceedingly well during a period of time when the bonds were supposed to do well.
Yeah, exactly. And 2015 was a year where almost everything worked for us. We'd like to repeat that every year, but there's going to be times where we've got, maybe a couple things where there's a little bit of relative weakness for a short period of time. Doesn't mean it's not going to turn back around. Most of everything we've done worked very well last year, and a lot of our strategic calls have been the right ones. But here's just a few areas of relative weakness, so I just wanted to explain what's driving that. And bottom line is the answer in both cases for the multi-strategy and global equity is that poor quality outperformed high quality. In some cases, we're not going to be a manager that focuses on poor quality to get better returns for the short term. We'd rather have a longer term quality bias in the portfolio, and we feel that that's the best way to go. Longer term, we do expect the multi-strategy portfolio to outperform. Here I'm showing you when it's outperformed, when it's underperformed. Even in a good bond market, there's only been a few instances on a 3-month basis where it's underperformed. So we'd expect things to turn around. Moving forward quite conservatively, we'd say bonds should do maybe 1.7% versus the multi-strategy at 5.5%. Historical returns have been over 8%, so we do feel that we can hit the 5.5% returns, which on a relative basis should help us to outperform a portfolio that has all of its exposure to core bonds. Investment market themes and outlook. You can see how things have turned around. The year started off very weak. January and the first 11 days of February, if you remember, there was a significant sell-off in the market, a global market correction, as they call it, which means 10 to 20% slide in the markets right around the world. Well, following that, you can see how things bottomed out and really turned the corner. There's been a few bumps in the way with the Brexit result, a few sharp sell-off days. Then the market rebounded nicely in Q3. Trump wins the election. You can see how the market tilted down, but immediately turned on a dime, and we had a really solid Q4 in the end. So it's nice to see the positive trend. And you can see now how fast the market moves when something like the Trump election happens. Between from the election, following the election, from November 8th to the 15th, you can see how things that benefit from faster U.S. economic growth and deregulation moved up in value. And keep taking point, this is 1 week. And U.S. bonds dropped in value because of the expectation that interest rates are going to go up. And then, for things like increased trade barriers, how non-U.S. stocks, emerging markets, and the Mexican peso immediately fell within just 7 days. So the market is pricing in things fairly quickly, sometimes overshooting to the positive, overshooting to the negative, but just wanted to make the point that things did get priced in quite quickly here. So what are the risks from the rest of 2016 into the new year? Well, China, still got to see how things unfold there. Certainly, there still is a chance that China could have a hard landing, and we need to watch that. The U.S. recovery continues to move forward here. Just want to make sure that that doesn't stall. Interest rates have already moved up now in Q4, and that's driven the bond market down. And there's an expectation that over the next 2 to 3 years, rates will continue to go up in a regular way in the U.S. Canada will likely follow suit. And then there's continued political risk. There's other elections happening around the world, and that can certainly drive things. Volatility, we think this is the new normal. You can see this is just a fairly short period of time between December 2014 and December 2016. But you can see when China was having its currency devalued, how that spiked the volatility in the market. There's also some concerns with oil and the Fed and China, in around this time, 2015. The Brexit vote back in June spiked the market volatility, and then the U.S. election just recently spiked volatility in the markets. And essentially, what we think is happening here in the markets right now is that moving forward, our 10-year forecasts have dropped. We don't think that stocks are going to deliver 10+% returns like they've had in the recent past, even 7 to 9, which we might have talked about in the past. We're just trying to lower our expectations a little bit here, given how buoyant the markets have been and what we see unfolding here in the market. So we think 5 to 8 might be the new normal. So global equities might get us around 5.7, Canadian stocks around 6.4 in the coming years. So we're just trying to lower expectations just a touch. And when you look at the long-term average in terms of price to earnings multiples, we are trading a little bit above that. So the stock market has become just a little bit more expensive. So we just have to be mindful of that. Recently, demand for oil has been rising, supply has been declining, so that's led to a decent recovery here in the energy sector. Fixed income results, we expect them to be quite low. You can see what's happened here just in terms of rate yields rising in the bond market right across the board, and that's led to a bit of an impact of lowering bond prices. Spreads have narrowed between Canadian corporate bonds and more investment grade bonds. So everybody seems to be focused really on the U.S. election and what Trump as president could mean. And I think we should just cover off the positives as well as the negatives. On the negative side, increasing trade barriers is certainly something that's concerning. We need to watch how that unfolds. Certainly, there's a lot of talk about there being increased geopolitical risk out there. Labor is going to become more restricted. We just really need to see how this unfolds to see what actually passes. On the positive side, and the reason the markets have reacted well, is that there's likely going to be corporate and personal tax cuts. There's going to be increased deregulation, which is good for smaller companies and even the private business community. It should bring jobs back in the U.S., which should be helpful for the economy. And there's going to be a lot of infrastructure spending. Trump was talking about spending close to $1 trillion on infrastructure. So these are all areas that should benefit. Doesn't mean we should take our eye off the potential negatives. And every day there seems to be new news flashes on what Trump is planning to do, and we'll just have to see what actually unfolds and how that could impact things. Consumers and businesses are certainly becoming more optimistic. Here you can see consumer sentiment. You can see how that's been trending quite positive since 2011, 2012. Outlook for business is also improving. Small business optimism is moving up. That's something we want to see. We look at Trump policies and how that could potentially impact GDP growth, and our view is that it'll be at the low end of these ranges, but we're looking at potentially about a 15% bump to GDP on average. So we're somewhere in the 5 to 15% range because of some of the things that Trump wants to do. But generally, spending money does drive the market. We just have to watch to see that we don't want this to become a situation where it's short-term gain for long-term pain, and that's what we need to keep our eye on. Generally, though, the U.S. economy is looking quite solid, continued to improve in the second half of 2016. Unemployment is at a nice low level here. We haven't seen these levels for quite some time. So we'd actually say that the U.S. is at full employment. Wages continue to rise, which is also a positive trend. Obviously, you want to have people working, earning a decent wage. That means they can save more, spend more. Consumer sentiment, I've showed you before, is also quite strong. So that's a pretty positive sign. Canada, there has been some structural headwinds, but we've seen some improvements lately. The OPEC decision will certainly benefit Canada. We've seen production moving up, stabilizing here a little bit. The service sector continues to improve. Canadian jobs report is coming in quite strong, so that's a recent positive. European recovery has been fairly slow. Inflation has flattened out, as you can see, but sentiment has also deteriorated a little bit. So it's something we just need to watch out for. The Eurozone certainly just has to get things a little bit more coordinated, moving down a more positive path. And as I showed you earlier, the international markets were one of the weaker areas last year, down 2%. China's activity will likely weaken further. We've seen fixed asset investment down. Now it's leveled off here a little bit, but the general trend here has not been positive. Consumption's been decelerating as well, and that's one of the reasons that China had a fairly weak last year when I showed you that other chart. So what does it all mean when it comes to building portfolios? At the end of the day, we still need to invest in stocks, bonds, or cash, or alternative investments in the case of Connor, Clark & London and other firms as well. But in general, here's all the different tools in the toolbox, and you can see what we like the most, what we like the least. And generally, what we're really favoring is global small companies moving forward. Shorter-term bonds are going to have less interest rate risk attached to them versus, say, core bonds. And we've already started to see the sign of core bonds underperforming. High-yield bonds we're a little bit more neutral on. We're a little bit more neutral on Canadian small companies and large caps in Canada and around the world. We do favor global small companies. But you'll notice that all of the alternative investments that we have, real estate, infrastructure, multi-strategy, are all areas that we favor. And there's a new asset class that we're getting involved in called private loans. And we did a separate call on this a little while back, Scott. So if anybody wants to learn more about that, that might be a good thing to listen to.
Yeah, no. So on this note here, so what I'm seeing, if you just go back one slide there. So what I'm seeing, okay, obviously you're saying, the alternatives, first of all, the tools in that alternative toolbox are increasing. From when we started many years ago, we just simply didn't have that many tools there. So we're starting to see that happen. And that seems to be driven from the fact that we are, just looking at the fixed income component of the portfolio and saying, it's probably not going to be the place that's going to be generating the yield we're looking for. We've got to find alternatives, because the only other alternative, instead of going to what you're categorizing as the alternatives here, is to go to the equities. And that's just simply means we're increasing the risk of the portfolio. So making that transition makes a lot of sense. But I guess the question that's been going through my mind is, on the fixed income side, it's always been seen as the lower risk portion of a portfolio, but the reality is, with the way the economic environment is, the way that we are sort of at that inflection point and that turning point on the interest rate environment, does that not mean that risk on that component, that's part of the portfolio, or the fixed income side, does it not mean that risk has increased in that side?
Absolutely. I mean, interest rate sensitivity is a big factor when it comes to when you look at how a bond portfolio does. And because we're at more or less all-time lows in interest rates, they've started to move up now a little bit. We do have to factor in lower rates of return. In fact, this chart here shows what happened in 2016. So you can see bonds did 1.7. We think that could be the new normal. There's going to be volatility in around that. Quarter four, things were down 3.4% alone. But we think in the next 5 to 10 years, that's 1.7 would be a reasonable rate of return out of traditional core bonds, which is why we like to look at things like high yield bonds, where we'd expect, not 13.2 like the high yield bond market did last year. But even if we do 5, that's going to be a pretty good return trade-off relative to core bonds. So that's something we're already doing for clients. Multi-strategy is also something that we've incorporated, where we'd expect more like 5 to 8% returns, and we've done over 8, so we're feeling quite happy about that in the portfolio. But even in stocks, I mean, last year, forget about 21% being repeated over the next 5 to 10 years. We think in and around a 6% return for global equities and Canadian equities is more reasonable. So global equities should do a little bit better moving forward than what we've seen in the last year. Canadian equities will do quite a bit weaker. But in general, for a balanced portfolio, if you're looking at a 55-45 mix, it's not going to be easy to get that 7% return with bonds only doing 1.7.
Yeah, well, but that right there, that point that you just made is an interesting one, because this is what my concern is with people who are, managing their portfolios, who are not really aware that this is happening. The emotional response is they look at their portfolio, they see a balanced mandate, and they say, okay, well, my stocks are doing fairly well. My bonds are really not doing as well as they could be. I want more stocks. But what they don't realize is, something you mentioned earlier in the call, which was the new normal is greater swings in volatility. So if that's the new normal, and you're now putting more of your portfolio, people with unknowingly putting more of your portfolio into an asset class that's just attracting more volatility, which is very difficult to see when you're just simply looking at historical performance, in the sense that, my stocks did better last year than my bonds, so I want more stocks. When people are making those types of emotional decisions, what they're failing to see necessarily is the fact that they're increasing their risk of the portfolio by exposing themselves to those traditional asset classes that are simply having more swings. And when we do go through the next correction, which, we go through business cycles, and corrections aren't, they're part of the experience. And it's not like we like the corrections, but they're just part of the natural experience. But when they go through that, in order for them to get the long-term returns that they've seen from certain asset classes historically, they have to be able to withstand that volatility. And if they can't withstand the volatility that they attracted to themselves, then they're really putting themselves in a pickle.
Yeah, no, absolutely. And so that's why we look at this, we talk about the investment toolbox. Fortunately, we don't need to rely 100% on traditional stocks, bonds, and cash. Clients that can accept things that work a little bit differently, gain a level of comfort around that. And where liquidity is not as important, you can make some longer-term commitments into things that have a little bit less liquidity, but have very attractive risk-adjusted rate of return features. In the past, a 7% return, if that's been the goal in a balanced portfolio, you could have done that with almost all of your money in bonds. That's going back to 1995. Just 10 years later, portfolios had to change to incorporate more equities, less bonds, and even add some alternative investments. But notice how the risk has gone up a little bit to get the same return. Flash had another 10 years. What we're now seeing is that to generate those kind of returns, you got to reduce bonds, reduce stocks, and increase alternatives. So we just really rounded out our toolbox here, so the clients can start to take a little bit of action. And if they want to incorporate some alternative investments, take the time to understand them, we do believe it's a way to generate some better returns moving forward. So you got the traditional stocks, bonds, and cash right around the world. We talked about our multi-strategy portfolio, real estate, infrastructure over the last many quarters, many years. Private equity is something we're doing as well. That's very illiquid. And now we've launched private loans. And here what we're looking to accomplish is in and around 7 to 9% returns relative to what we might expect in the bond market of 1 to 3, say 1.7 over the next 10 years on average. We see it as being a very stable asset class and providing an active yield. We'll build a portfolio of approximately 20 loans, anywhere from 2 to 10-year terms, to quality mid-sized companies that have a track record of operating for 5+ years, 10 million a year in terms of earnings, 100 million plus in assets. So good, stable businesses where we can have a first lien on the assets of the organization, or a second lien in some circumstances. But we think there's a particularly interesting opportunity in the marketplace today. So we've brought a team to the table that can do this for us. And starting now, we're accepting commitments into this asset class. For a typical client that's comfortable with the asset class and a little bit reduced liquidity, about a 5% allocation would be something that makes sense in our opinion. But really, it's a personal thing. So I'd say for any clients that have interest in chatting about this and how it can positively impact them, I'd say let's have a conversation and see where it goes.
Yeah, no, it makes a lot of sense. And we did do a much more detailed review of the private loans. So I'll put a link to that with this video so people can link to that and find out more about that.
No, that sounds good. This is just, I didn't want to, be too bleak on the return situation for a balanced portfolio. I mean, about a 5% return is still a decent return. And, we're making some pretty conservative assumptions here around stocks and bonds. Maybe things unfold more attractively than that. But if we set our expectations based on reasonable expectations, I'd rather be surprised to the upside. Now, the range of returns on an annual basis could be anywhere from 1 year to the next, could be between -5 and +15, with just a typical balanced portfolio that includes no alternatives. But you can see what happens to the return when you add just one alternative, like our liquid market multi-strategy portfolio. The downside is a little bit lower, your return is a little bit higher. Now you add some real estate and infrastructure, the multi-strategy, and returns go up again, your downside is a little bit lower. Now you add a little bit of private loans to this scenario, and again, return is up and risk is down. So there is a real math and science to the markets. So even using conservative projections, what it allows you to do is get a little bit of extra return, and meanwhile lowering the risk. So that's something we like to try to accomplish. And we got to look at the potential for declines in a portfolio. So a 55-45 portfolio, we know it can decline more than 10%. We know it can decline more than 20 or 25 in extreme circumstances. But what we're trying to do is reduce the likelihood of that happening. So a 10% decline in a balanced portfolio, I mean, there's lots of times where the market's correct 20+%. And so the chance of a 10% decline is pretty high in a balanced portfolio, at least once over a period of time. But you can see when you add all of these alternative investments, the likelihood of a decline is quite a bit lower. And when you look at something like a 20% decline, it dramatically reduces the chance of that happening to incorporate some alternative investments. So that's really what we're trying to accomplish when we just build a little bit of alternative exposure to the traditional. Real estate and infrastructure, both portfolios continue to do quite well for us here. Real estate market has still been quite stable. Quarter three, as I said, the portfolio is up 2.8%. Year to date, up 7.5%. On a 1 year basis, up 8.9%. Since inception, the portfolio has done almost 12%, up 11.8%. Infrastructure has done quite well as well. Quarter three was strong, up 6.4%. In the first 9 months of the year, up 13.7%. 1 year return up 18.5%. Since inception, 18.39%. And the goal for these portfolios has been an 8 to 11% return with about half the volatility of stocks. And certainly the portfolios have done a good job of building that. Real estate, we're now highly diversified right across the country in high demand, low supply markets like the GTA, Ottawa, Montreal, Edmonton, Vancouver, Regina, a mix of commercial, industrial, retail properties. And generally speaking, the market's still looking quite strong. But even if we just look at the yield that we're generating in the portfolio, which is around 8%, as being a forward expectation around return, that's pretty attractive in this new normal market. Infrastructure, the Liberal government's obviously very supportive in the area. We've had a couple positive things happen recently with a portfolio refinancing in the Kingston Solar project, which is 100 megawatts in size. So that's one of the largest renewable bond financings ever completed, and it really does de-risk this important investment for us. And then we also just recently added another highway project called the South Fraser Perimeter Road in BC. It's a 40-kilometer highway. This is actually a completed project where the construction is already behind us, but we had an opportunity to pick that up at a reasonable valuation, and that's going to help the portfolio to develop some stable streams of cash flows. Ryan, why don't you cover off this chart? I meant to introduce Ryan again up front. As you heard last quarter, Ryan's joined up with me to work with Scott and clients. So Ryan, maybe you can cover off this chart.
Yeah, of course. I think this chart speaks well to the discipline needed to maintain a balanced approach. If you go back to 2015, you look at the top line there, you'll see global equities leading the charge in terms of a rate of return, and then 2016, Canadian equities leading that charge. But the inverse between the 2 years and what it means to maintain that balanced approach instead of trying to put all your eggs in one basket and maybe guessing yourself from year to year. So you'll see a balanced portfolio can really stand the test of time. And on average in 2016, reporting about 7% in terms of an index return with a standard deviation since going from back to 2007 with about 6.4%. Again, beating most asset classes, but maintaining that smoother ride over trying to pick the most or the favorite asset class over that particular calendar year.
Yeah, and that's what helps people stick with it. It's the huge swings that are so negative to people's experience, and actually it's what drives their emotions to get them out at the wrong times, and then it drives their emotions to put them back in at the wrong times. So seeing the balance being sort of on the above average, smoother year by year sort of experience is exactly what people need. So it's nice to see that that's how the numbers are shaking out here.
Yeah, and you're 100% right. Trying to time whether it's timing an entry point out or trying to time an entry point in is quite difficult. But if you can maintain some discipline around that balanced approach, then it'll definitely serve you well in the longer run.
And this is just, thought we'd just end on this just to show how the company continues to evolve here. I joined the company in about 2003, so I've seen the company grow nicely from about 400 million up to about 6.2 billion that we now manage. But you can see how continually there's been investment in the company, both in terms of infrastructure and asset classes, multi-strategy being added here in 2003, global small companies in 2008, high yield, then a few years later, real estate and infrastructure were added to the portfolio, some other income portfolios, now recently private loans. So we're always trying to think ahead and figuring out what else do we need to deliver solid risk-adjusted rate of returns for the markets that are coming down the road, and so far so good. We're happy to see a positive trend here, and hopefully you and your clients are as well.
Yeah, well, this is great. Well, I appreciate you taking the time and sort of going through all this, because it really, it's important for people to understand what's been happening and what the plan is going forward. Because historically, things have happened as the way they've happened. But I think right now is a time when, if we make our decisions based on what's happened historically, I think we're going to be caught short. We're going to be caught with wrong decisions going forward, and we really need to be able to identify the probabilities of what's going to be needed going forward. And as you guys have done by bringing in the other asset classes that are going to complement what's required and what we need moving forward is sort of the key to the long-term success of any portfolio. So this is great to go through this and give people a bit of an exposure on what's available within this structure and what the strategy is going forward. So thanks very much, guys, for taking the time today and going through all this. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel. youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.